Hi, hello. So welcome to our new video, which is on risk management. So before we start with this, here is a disclaimer. I am not a SEBI registered advisor, and the content here is for educational purposes only. So what all topics we will cover today? So here is the agenda of the topics that we will be talking about. Okay, so I really want to tell you something. Most beginners don't hear early enough. So what I mean here, which means you don't lose money in the stock market because you picked up the wrong stock. So the stock market does not destroy people overnight. So but what it does, it slowly punishes undisciplined behavior. So what I mean by undisciplined behavior, so that is no proper risk management. So you lose money because you did not manage your risk properly. So when you first started, so you only focus on entries like where to buy and when to buy or which stock to buy. So what you missed here is, so in case if this goes wrong, so the question that you should ask yourself before you start investing, because success means not finding the right stock, not spending hours on research. Okay, so that is when I started asking one question to myself. So what happens if I am wrong? And the first time I faced a real loss, I realized something uncomfortable. Because whenever you lose money, you get that uncomfortable or you become emotional. But the problem here is was not the market. So the problem was that I had no risk structure. So today we are not talking about profits. So today we are going to talk about the most important skill in investing and trading, so which is risk management. So we are talking about the survival, because survival is what allows us to growth. So that's why you should have discipline and you should have a proper focus to do that. So here is a truth that separates amateurs from professionals. So you will be wrong most of the times, not sometimes, but most of the times or regularly. So let's be clear about something. So no one is 100% of the time right, not even professional traders, not even hedge funds, not even billionaires. So losses are part of the market. So even experienced investors are wrong. So the difference is simple. So professional lose small, beginners lose big. So if you lose 5%, it is manageable. If you lose 50%, recovery becomes emotional and mathematical pain. So risk management is not about avoiding losses. So it is making sure that so the losses don't define you. So the difference between beginners and experienced investors is not about avoiding losses. So it is controlling them. Like how you control your losses becomes very, very important. So if you look at the table there, so, okay, imagine you have a capital of 10K. So there are two different scenarios I will explain. So if your scenario A, so when you lose 5%, what happens? You only need to recover 5.26% to become equal. Okay, so if you see the second scenario, so if you lose 100%, okay, which will reduce your capital to 5,000, and how much it is required to gain to recover, this is 100%. So if you understand this properly, you understand the risk management very well. So this is why professional focus on capital, protecting capital first. So what is the first rule? First rule here is never risk what you can't afford. Never invest money you can't emotionally and financially afford to lose. Because if you have kept some amount for some other purposes, so you should not invest those kind of money here. So there are two types of risk. Financial risk, which means how much money you could lose, and emotional risk, how much stress you can tolerate because of losing your money. So when I invested more than what I could lose, so I did not think very clearly. So I kept on checking charts. I reacted to small movements that was happening in the market. And if the market drops 10%, so it will definitely stress you out because of the panic. So that is what it means. If you are investing too much, so it will be your emotional risk, or you can't maintain your emotional balance properly. So you should learn this very hard way, or you can try to understand by listening to this recording. So that's when I understood, if your position size controls your emotions, you are too much exposed, because calm decisions require controlled exposure. The moment money becomes emotionally heavy, your decision becomes irrational. So you can't think properly, so you can't execute properly. So that's why investing should feel controlled, so not desperate. Position sizing. So one of the simplest but most powerful concept is position sizing, which means how much of your capital should go into one idea. So early on, I would go heavily into one stock because I believed in it. So belief without structure is gambling. Okay, so that's what we will not do today. So we will not just gamble. So we will learn properly and we will invest, and we will do our position sizing properly, and also we will also do proper risk management. So never put too much of percentage of your capital in single stock. So diversification isn't boring. So diversification means protective. So you can ask yourself, so in case if the investment fails, so will you be financially stable? If you get an answer no, which means the position is too large. Some small positions protect you, and protection creates longevity. So you can see from the table for two different options: investing heavily in one stock and what is the loss, and investing or diversifying your amount and what is the loss when the same percentage falls in the market 20%. Can see the huge difference there. So that's why different emotional impacts will impact you. So based on your position sizing, so that's why you should control your exposure. So it will reduce your stress during live market. Yeah. So this is another hardest lesson: admitting that you are wrong. Holding and hoping, it might be very comfortable for a short time, but it is very dangerous, because when you feel you are wrong, so you should immediately exit from that position. So as I said, exiting might feel very painful, but the market doesn't reward if you have ego, so it will rewards who have the adaptability and flexibility. So when your original reason for investing changes, so your decision should change immediately, because discipline beats pride, and discipline means knowing when to exit when your position is going wrong. So risk reward. So before entering any investment, so you need to change your mindset. So don't ask yourself how much can you make out of this stock, but you need to ask yourself like what you are risking. If you are risking 1 to potentially gain 3, so that's a structured risk. But if you are risking 5, hoping to gain 1, so that's emotional. So great investors think in probabilities, not in predictions. So before entering any investment, ask yourself, is this decision calculated, impulsive, or a structured? You can see the image here just for a reference. So what is the risk I am keeping, and what is the reward so I am getting? So this is how it should be for yourself. So the first arrow shows if you are entering at that stage, because it is forming in hammer candlestick pattern, keeping the low as your stop loss and riding it. So see the difference. So that is how your risk reward should be, and that is how you should make money. So there are different disturbances that occurs in the middle, but you should know how to avoid those disturbances and how to properly position yourself. So the long-term investors and risk. So if you are a very long-term investor, so risk management matters because it shows up as diversification, and you should have very patience, you should be consistent, and you need to avoid the hype if you are a very long term investors, because there are a lot of disturbances that happens daily in the market. So you need to avoid all those disturbances, you need to be very patient, you need to be consistent, and you need to be diversify your investment. Because risk management, it's not only about the stop loss, sometimes it's about your behavior, like how you perform under pressure. So and the performance under pressure defines your outcome. So now that you have learned a lot of topics about position sizing, risk management, long-term investment, risk and reward ratio, so what to do when you are wrong, so what is the real edge? So we usually think edge in the market is intelligence, okay, but it is not intelligence. It is how you control your emotions. So here is something I want you to understand very, very deeply. So the market doesn't reward intelligence alone. It will reward emotional control along with your intelligence, because the investors who have survived decades are not the one who have predicted the market perfectly. So they are the ones who have protected their capital consistently and shifted to get a big win and trying to lose small. So that is where the real edge is. So you need to make sure that you lose small, you win big. Proper risk management, proper risk reward ratio, proper position sizing. So if you follow all these principles, so that is what the real edge is, along with your emotional control. So that is when everything will improve. So now you have now you got the basic understanding of what most beginners ignore, because risk management, it is not optional, so it is foundational. So in the long term, we will also, in the next video, we'll also talk about how long term investing framework, something stable, structured and realistic things work, because training is not about excitement, so it's about the preparation. Yeah, I hope I will see you in the next one. So kindly like and subscribe to this channel for more videos.